8 times per year, a committee of 12 people meets in Washington, D.C. and decides the most important interest rate in the world. Their decision moves your mortgage rate. It moves your car loan rate. It moves your savings account rate and the rate your credit card charges you. It moves stock markets globally. And yet, if I asked most people to explain what the Federal Reserve actually is, who runs it, or how interest rate decisions flow through to their personal finances, most would struggle. Let's fix that. The Federal Reserve was created by Congress in 1913 after a series of banking panics, the worst being 1907, when J.P. Morgan personally had to bail out the U.S. banking system with his private fortune. Congress decided the country needed a central bank that could act as a lender of last resort, an institution that could provide liquidity to solvent banks during panics and prevent runs from becoming collapses. Today, the Fed is a hybrid public-private institution with 12 regional Federal Reserve banks and a board of governors in Washington, all ultimately accountable to Congress. The Fed has a dual mandate from Congress: maximum employment and stable prices. Stable prices means keeping inflation at approximately 2%, a target formally adopted in 2012. Maximum employment doesn't have a specific number, but the Fed generally considers 4 to 4.5% unemployment consistent with the target. When inflation runs above 2%, the Fed raises rates to cool spending and borrowing. When unemployment rises and growth slows, the Fed cuts rates to stimulate activity. These two goals frequently conflict. Cutting rates to fight unemployment can fuel inflation. This is the fundamental tension the Fed manages. The primary policy tool is the federal funds rate, the rate at which banks lend reserves to each other overnight. The Fed doesn't directly set mortgage rates or credit card rates, but the Fed funds rate is the anchor for all short-term borrowing costs in the economy. When the Fed raises the Fed funds rate, banks' own funding costs rise, and they pass those costs to consumers through higher loan rates. When the Fed cuts rates, borrowing costs fall across the system. The transmission mechanism isn't instant or perfect, but it's powerful. The impact on your specific financial products. Mortgage rates. A 30-year fixed mortgage rate typically runs 1.5 to 2 percentage points above the 10-year Treasury yield, which moves with but isn't identical to the Fed funds rate. HELOCs and adjustable rate mortgages move almost directly with the prime rate, which is Fed funds plus 3%. Credit cards. Most variable rate cards are directly indexed to the prime rate. When the Fed raised rates from 0.25% to 5.25% in 2022 to 2023, average credit card rates went from about 16% to 27%. Savings accounts at online banks. These moved up quickly. Savings accounts at big banks, they barely moved. Quantitative easing, QE, is the tool the Fed used when rates hit zero and they needed to do more. Rather than cutting rates further, negative rates, the Fed bought trillions in U.S. Treasuries and mortgage-backed securities, injecting money into the financial system and suppressing long-term interest rates. The Fed's balance sheet grew from $900 billion before 2008 to $9 trillion at its peak in 2022. QE lowered mortgage rates, inflated asset prices, stocks, and real estate, and is one key reason asset owners did well during 2020 and 2021, while wage earners struggled. The Federal Open Market Committee, FOMC, meets 8 times per year. Investors and markets watch these meetings obsessively because the rate decision and the accompanying statement move financial markets significantly. The dot plot, a chart showing where each FOMC member expects rates to be in future years, is released quarterly and gives guidance on the rate path. Understanding how to read Fed communications is genuinely useful. When the Fed signals rate cuts, long-term bonds rise in value and the dynamic shifts for borrowing. When it signals hikes, the reverse. The practical moves based on Fed rate cycles. When rates are rising, lock in fixed-rate mortgages before rates go higher. Avoid variable rate debt. Move cash to HYSAs or short-term treasuries that benefit from higher rates. When rates are falling, consider refinancing fixed-rate debt if it makes sense. Recognize that HYSA rates will decline and understand that bond prices rise when rates fall, so existing bonds become more valuable. Rate cycles don't move on predictable schedules, but understanding the direction changes your near-term financial decisions. The Fed's independence from political pressure is the feature that makes it trustworthy and the feature that makes it controversial. The Fed chair, Jerome Powell through at least 2026, is appointed by the President and confirmed by the Senate to a 4-year term. The Board of Governors serve 14-year terms. This long tenure and the institution's explicit mandate to be politically independent means the Fed can do unpopular things, like raising rates during an election year, that elected officials couldn't. That independence is why markets trust the dollar. When it's questioned, markets notice. The Federal Reserve doesn't control your salary, but it controls the cost of everything you borrow and the return on everything you save. That's a massive range of your financial life. Understanding the basic mechanism, how rate decisions ripple from the Fed's conference room to your mortgage payment, is foundational financial literacy. If you want to understand how inflation data informs those rate decisions, our video on how inflation is actually calculated covers exactly what the Fed is looking at when it decides whether to cut or hold.